Hello everyone, welcome to Worldfxclub. So the legendary investor Warren Buffett says that you should follow two rules while investing. The first rule is never lose your money, and the second rule is never forget rule number 1. So in investing and trading game, we can survive for a long period when we can save our capital. Okay, so to save our capital, you can use stop loss orders, and in today's video, we will discuss what is stop loss and how can investors minimize their risk by using it. So let's get started. So a stop loss is an order after which if the stock touches a certain price, it will be sold automatically. When stock price touches a certain price, a market order is immediately executed and our stocks are sold. For example, if an investor buys a share at rupees 25 per share, he wouldn't bear a loss of more than 5 rupees per share. So he or she has to limit the risk. Then that investor can put a stop loss order at rupees 20 per share. As soon as the stock price will reach rupees 20, the share will be sold automatically. And whenever the prices fluctuate rapidly, in that case a stop loss order can be really helpful for you. Now we have understood what is stop loss order and why is it used. But whenever we talk about stop loss, investors confuse it with stop limit order. By the way, the purpose of both are almost the same, but they have a small difference. As we discussed, in a stop loss order, when the stock price hits the trigger price, then a market order is executed, but our stock is sold. In stop limit order, when the stock price hits triggered price, then our sell order becomes a limit order. That is the difference between these two. So the difference is the market order is executed immediately while the limit order is executed at the stock price crosses the limit price. Let's understand both orders with a very simple example. We had put rupees 20 stop loss. After this, if the stock price goes from rupees 25 to rupees 21 and then to rupees 17 per share, then the stock will get sold at the prevailing market price, which is rupees 17 per share. But in stop limit order, it doesn't happen. In stop limit order, when the stock price falls below rupees 20, our limit order will automatically activate. If we have put stop limit order, it ensures that the stock won't be sold below rupees 20. This will be sold at or above rupees 20 only. Yes, it may happen that below rupees 20, the stock price may not touch rupees 20. In this case, the limit won't be executed. So the difference is that when the stock price will go below rupees 20, the stop loss order will always be executed. But a stop limit order doesn't need to be executed. The main purpose of a stop limit order is that many times stock price falls a lot below the limit order, at which investors don't want to sell. Investors want that when the stock price comes up again and hits the limit price, then the stock should be sold. In this case, a stop limit order is useful. We have understood the difference between stop loss and stop limit order. Now we will understand the advantages of a stop loss order. A biggest benefit is that it reduces your risk and saves you from big losses in the stock market. The second benefit is that it has no emotions attached to it. In emotions, investors try to give a second chance to bring their stocks back at profit, but it doesn't happen in this case. But due to this delay, investors have to face heavy losses. So the stop loss saves you from emotional attachment and helps you exit from the stock at a right time. The third benefit is that the stop loss order reduces losses but also helps you to lock your profits. Suppose you bought a stock at rupees 100 per share, then it comes to rupees 150. You expect the price to rise. Also, you want to lock profits. In this case, you can put rupees 140 as a stop loss order to protect your profits. After this, if the stock price goes below, you will be able to earn rupees 40 profit. The other benefit is that a stop loss order, you don't have to actively track your stock and monitor how a stock performs daily. So these are some few benefits of a stop loss order. Now let's talk about its disadvantages. The main disadvantage is that due to a short-term fluctuation, the stop loss order will be activated and the stock will be sold because it activates the trigger price. So it's very important at what price you are setting the stop loss. For an example, an active trader can set his stop loss at 5%, but for a long-term investor, it can be more than 15%. Another disadvantage is that a stop loss order executes a market order to sell. Hence, your stock may get sold at rupees 17 also, like we saw earlier. To avoid this, you can use a stop limit as well. The risk in stop limit is that many times your order is not even executed. So we discussed what is stop loss and how it is beneficial for investors. Stop loss order can save you from heavy loss and you can exit from the stock at the right time. Also, you can lock your profits with it. What else do anyone need? It is useful for both intraday traders as well as long-term investors. So if you found this video useful and liked it, kindly hit the like button and subscribe to our channel. Thank you.